welcome to Monday's edition of Daily Trader. I'm Alex Coffey in for Kevin Hinks here on the Schwab Network YouTube page. As we look at the market here, setting up this holiday-shortened Thanksgiving week, a lot of green on the screen in U.S. equity markets. S&P 500 did trade over 6,000 to start the day. It has given back some of those gains intraday. We have a heat map up on the screen just to show how broad that rally really is. But right now, S&Ps are up around 20 as we're about 45 minutes into the trading session. But notably, here in real time, about 85% of the S&P 500 names are green in some fashion. But you'll notice there's a big red box there. That, of course, is NVIDIA. NVIDIA is really weighing on the market here intraday as it continues to slide now post earnings last week. It's down almost $5 here in real time here on this Monday morning to kick off this week. So certainly putting some pressure on the market. It's joined by other big tech names like Tesla, CrowdStrike, Netflix, and Microsoft, also all red on the day. And so what we saw a lot last week, and it seems to be shaping up at least early in this week's trading, is sort of a Mag 7 or big tech weakness last week. And then you saw the rest of the market kind of picking up that slack. Now, the sustainability of this remains to be seen as we've had a market that's been so concentrated in those big tech names. Can new leaders emerge, especially if you do start to see weakness in some of those market generals like the NVIDIAs, like the Microsofts for some sustained period of time? But so many of those names were big beneficiaries of the AI trade as this build out, these hyperscalers and Gen AI continue to build things out and buy chips from places like NVIDIA notably. But as we look ahead, one analyst by the name of Dan Ives over at Wedbush believes that you may see the next wave of the AI trade start to build out. And that may be most notable and prominent in names in the software space. Dan Ives talks about the broader software space getting in on the AI party. He believes the use cases are exploding for what AI may do into 2025. He talks about wide consumption phase beginning in 2025 with the launch of large language models across the broad market as a whole, and the true adoption of generative AI as a major catalyst for the software sector. Now, two of the names that actually got some love from Mr. Ives today are the likes of Snowflake, which of course had earnings last week, and Palantir, which had earnings in the last few weeks as well. Both really nice performers over the near term. You're really starting to see the momentum pick up, notably in the first name that we're going to talk about today, which is Snowflake. This is a name that beat earnings by a monster, 30% plus versus the estimates. And it saw a similar rally of about 32% post earnings. Snowflake really changing sentiment around this stock. And you can see that RSI much into the overbought territory, up in the 80s for the RSI. Really goes to show just how much force was behind this rally last week. Now it's building on that today as Mr. Ives gave that price target update in the stock and the outperform rating. When you look at where he has it slated, he put a 190 price target alongside that outperform. It's getting a little bit of a bid today. It's up about $10 again here in real time, a little bit under that to just under 177 a share. From an example trade standpoint, we know oftentimes that these names, when they start to get these momentum rallies behind them, they may fizzle out, but until they do, the moves can be quite powerful and go on beyond what you think might have been possible beforehand. So what I looked at was a call calendar spread in this particular name for a couple reasons. One, it allows the trader or investor to target a particular price level. That can be to the upside, that can be a neutral price target, that can be a price target to the downside, although if they're doing a downside price target, they may want to consider using the put calendar as sort of the sibling strategy to the call calendar. But nonetheless, in our particular case, what we looked at was a relatively short-dated 200 call calendar in which we're selling December 6th, so going out just a few weeks, and then buying the December 13th cycle, looking for that debit to be relatively contained. And the reason being, with this particular strategy, it's a 50-cent debit, so it means a max loss of $50. It allows the trader, and it's all relative, of course, so don't get too caught up with these terms, but to aim small, miss small, right? And so what I mean by that is you're selecting a strike that you believe this stock could get to. So I chose the round number 200, see more of that rally, and need another 12 or so % rally to get there over the next few weeks. But momentum building, RSI way up in that overbought territory, earnings momentum behind it, analysts jumping on board. If you believe the stock could get higher, maybe it gets to 200 and that could be that level. But most importantly, it's the miss small. In the event that doesn't happen, the debit spent on this trade is the limited risk. So in this case, that's $50. Now, $50 is a lot to some traders, it's a little to others, but most importantly, relative to most of the example trades we talk about across the Schwab Network, I would say $50 is on the relatively lower side of risk. So with this one, it's looking for a move towards 200 over the next few weeks, and doing so with a risk-defined strategy, because at any moment, these momentum-driven rallies can turn and make a bit of a U-turn. You just don't know when that might happen. Now we're going to switch over to Palantir, another name that Mr. Ives upgraded and gave the price target hike to as well. Another name that's done really nicely post earnings, and so outperformed with a $75 price target from Dan Ives at Wedbush on Palantir. The stock up about $3 here in real time, and you can see also another name that has some momentum behind its rally. Now, it did dip just below that 70 mark on the RSI before recovering that this morning, as this rally started to go a little bit sideways, consolidating at new prices, but it is making a new high here on the year in real time at this 67 mark, that high intraday just below 68. But I wanted to look at a strategy that's sort of the next level within the calendar spread. This is a stock that has had the move, but it's a little bit further away from its earnings now. It maybe had its consolidation period, and now it's thinking about making its next major move, be that to the upside or the downside. With the Wedbush optimism, I went ahead and looked at a bullish example trade for this particular strategy, but we're looking at the call diagonal spread. Now, for the sake of conversation and for the sake of sort of the consistency across these two trades, I selected the same expirations. Of course, that could be customized for the different trader, but I wanted to kind of show about how these two strategies are similar and how they're different. And so in Palantir's case, we're buying the December 13th 68 call, and we're selling the December 6th 72. So unlike the Snowflake strategy, where the two strikes were the same strike at 200, the diagonal has two separate strikes, even though they're also across different expirations. And so what I always say with the call diagonal spread is that it kind of increases that margin for error for a little bit more risk. So you'll notice this is a $2 debit for this particular strategy. So that means you have $200 in risk. Last trade was $50, and we were actually talking about a bigger product as well, by a factor of about 3 when you think about Snowflake being around 180 and Palantir being around 60 or so. It's 3 times bigger product, yet you have 4 times more risk in the Palantir strategy. And the reason is because with that call diagonal spread, it tilts the risk profile on its axis and actually removes that overshooting risk to where, if Palantir were to make a monstrous move all the way through our strikes, you can see it actually levels out in that profit territory. And so for a little bit more risk, you increase your margin for error. At least that's how I like to think about it. That said, it's still a bullish strategy, and it still needs that move higher, ideally seeing that move to that 72 or so mark over the next few weeks. But with this particular spread, what you'll notice, the $200 in risk, of course, is the max loss scenario. This strategy is a little bit more capital intensive, but far more capital efficient than, let's say, buying stock shares in Palantir and creating, let's say, a covered call or something. Now, I know there's differences between owning a call option and owning stock shares. A couple that come to mind would be if there were dividends, for example, you wouldn't be right to that. I mean, there's an expiration date. Stock shares don't have that. And then, of course, if they were voting shares, a call option is not going to have those voting rights. Now, there may be other differences too, but those are kind of the three main ones. But software-oriented theme here today to kick off the Thanksgiving week on a green day for the market. We'll see if that can continue as optimism rolls in to Turkey Day. Thanks as always for tuning in to Daily Trader. I'll see you tomorrow.